What if the greatest fund manager in the history tells you that to be a successful stock picker, you are better off studying history, philosophy, and every curious thing about the world rather than studying mathematics, finance, and statistics? And that all the mathematics that you need to know to be a successful stock picker is what you have already learned in your 5th grade. Is that too hard to believe? It was hard for me to believe that too until I read this book by Peter Lynch. To those of you who don't know who Peter Lynch is, he is one of the greatest fund managers in the history. He amassed an annual return of 29.2% per annum for his fund at Fidelity Investments for 13 years from 1977 to 1990. After that, he finally retired, growing the money under management of his fund to $9 billion, which during that time was half of the gross national product of Greece. Had you done a SIP in his mutual fund worth $1,000 every month, he would have retired making you a millionaire in 13 years. Those kind of returns are highest by any mutual fund manager in entire world. This is the better investor helping you achieve your financial goals and freedom through organizing your finance, stock market investing, and learning from billionaires. And these are top 5 lessons from the book One Up on Wall Street, written by Peter Lynch. Lesson number 1: The birth of a stock picker. Investing in stocks is an art and not a science, and people who have the rigidity to quantify things have a big disadvantage. All you need to be a successful stock picker is common sense, which though is not so common. Knowledge about the business of which stock you have bought is the best preparation you can ever do, and that is the first and the 90% of being a better stock picker. And to find these companies is no rocket science. You just have to carefully observe your surrounding. For example, Dunkin' Donuts. Dunkin' Donuts opened its first store in America, Massachusetts in 1950. Lynch noticed that most of the people in his locality went there to get their coffee. Kids loved the sweet donuts and adults loved the caffeine. The store of Dunkin' Donuts were increasing capacity rapidly, and most of the times you had to wait in queue to get your coffee and donuts. It soon became a go-to place for most Americans for breakfast and snacks. Its share listed on the stock exchange in 1968. All this while, they had been rapidly increasing their stores. Yet, the first time any big firm or news channel or mutual fund started following it was way later. By this time, the stock of Dunkin' Donuts had already grown 10 times. Just the local people who saw Dunkin' Donuts increasing stores in the locality and its popularity had enough edge to go out there and read out about the business of Dunkin' Donuts way before any big institution ever came to know about it. Lesson number 2: Know your edge. In general, if you polled all the doctors, only a small percentage would turn out to be invested in medical stocks and more would be invested in oil. And if you pulled out a shoe store owner, more would be invested in aerospace and cement companies, whereas the aerospace engineers are more likely to dabble with shoe store stocks. Why is it that a doctor who knows inside out about ethical drug business is more confident in investing in motor oil company about which he knows nothing? Though you literally do not need to know anything about a business for its stock price to go up, but oil experts on average are in better position than doctors to decide when to buy or sell Indian oil. Rice farmers on average know better about the prospects of a fertilizer company than he would know about a telecom company. If all of a sudden you see that in your friend circle people have started smoking Marlboros much more than the regular gold flakes, and you see the same at the shops, you have an insight about what is happening to the competition in between cigarette manufacturers. So people who buy stocks may get lucky despite being ignorant, but it is much like competing under unnecessary handicaps, just like a marathon runner trying to take up his reputation as a carpenter. Lesson number 3: Get there before institutions. One may think that big institutions and mutual funds have an edge. They have team of analysts, well-read people, and thus only they can invest money and gain significant returns, and that the company in which these mutual funds are invested in is the land of treasure, and small investors like you and me have no edge. Well, you would be surprised to know that 57% of the mutual funds failed to beat the index in the year 2020. And this story is not new. It is as old when mutual funds started existing. That means the probability of your mutual fund giving better returns than the index is even worse than the flip of a coin. Big mutual funds and institutions are bound by the framework. They cannot hold on to cash when the market is overvalued, the time when you should stay away from the markets. The size of the fund does not allow them to buy into small companies which may be on track to grow. For example, a mutual fund cannot invest $100 million and buy stocks of the company whose value in the market is just $50 million. Because your own buying would create sudden enormous demand of the stock and price would shoot up, giving initial big disadvantage to the mutual fund, whereas small investors is not bound by it. He has more options available at his gateway. The mutual fund managers are employees themselves and have a pressure of regularly beating the market. If they bought in stock that looked attractive to them, and if it had not given any worthwhile return in a year or two, they would be exiting the stock and look at new ones, because they would be called lazy for their inactivity and keeping clients' money in an inactive, underperforming stock. Not only that, they may run down the risk of losing their job. It is just like holding a gun on a person's head and asking him to put money in stocks for biggest gain, when actually no such opportunities exist at that moment. Plus, the large transaction results in large transaction fees. Whereas individual investor has an edge, that he has no pressure. He can hold on to a stock for 3 years, 30 years, wait for the market to be rational, and then mint all the upside. In centuries past, people hearing the rooster crow as the sun came up thought that it was the rooster's crow that made the sun rise. It seems silly now, but the TV anchor in the news channel and experts on them confuse cause of something into effect of something else and come up with new explanations of why market went up 2% today and fell down 1.32% last week. These causes will range from Chinese trade war, or a trend line has been broken, or maybe markets are oversold. Don't listen to anyone out there. Everyone is as dumb as each other. Big brokerage firms and mutual funds write reports on the company they follow. The news channels too are filled with these companies. But Peter Lynch says that just because a firm does not follow a company does not make it a risky company. Rather, that makes it more attractive, because when big mutual funds and institutions find about the company and they start to buy in large quantities, the price will go to the moon due to huge demand of stock. And if you have a doubt, don't forget the Dunkin' Donuts story that I told you about. Lesson number 4. The 6 categories of stock. Though this should be the first lesson, but anyways, the size of the company has a great deal with what you can expect out of the stock. Big companies don't have big stock moves. Okay, they have, but rarely. In some markets they perform well, but you'll get your biggest moves in small companies. If you think that Amazon can continue growing its revenue by more than 25% per annum like it has been doing, then its revenue would be higher than the GDP of many countries. Well, anything is possible, but just have some decent expectations. Once you have identified your company, you can place it into one of these 6 categories that Peter Lynch mentions, and how you deal with these categories is different. Category number 1, the slow growers. Usually, these are large and aging companies and are expected to grow slightly faster than the GDP of a country. Slow growers were once fast growers, and over time, as they went as far as they could, they slowed down. These are of the likes of Coca-Cola, Gillette, Infosys, McDonald's, Unilever, Colgate, Castrol, Johnson & Johnson. These have saturated their market, and now the only way they can do well is to find a new geography like Mars to start afresh. It's easy to spot a slow grower. The charts look like a topographical map which has no hills. These companies pay regular and generous dividends. Category number 2, the stalwarts. These multi-billion dollar hulks are not exactly agile, but they generally grow their profit faster than the slow growers of the order of 10 to 12%. The charts are not as flat with no hills, but are definitely not Mount Everest. These are of the likes of Britannia, HDFC Bank, Apple, Samsung, Domino's, Asian Paints, Titan. Depending on when you buy them and at what price, you can make a sizable profit in stalwarts. Don't expect a 10 bagger out of these companies before 15 years. Peter says that if a stock like these give him 30 to 50% return in a year or two, he would sell these and repeat the process in some stock of similar category that are still cheap. You're not going to be a millionaire out of it unless there is some startling new development. These stocks offer pretty good protection during recession and hard times. For example, the stock of Hindustan Unilever, a consumer giant in India, gained 5% during coronavirus stock market crash. Can you imagine? When everything was falling, it gained 5%, but since then, it is still there and has not given any return. Category 3, the fast growers. These were Peter Lynch's favorite. These are small, aggressive enterprises that grow at 20 to 25% a year. If you choose wisely, this is the land of 10 to 40 baggers and even bigger. With a small portfolio, one or two of these can make your career. These are of the likes of Netflix, Amazon, Jio, Relaxo Footwears. They need not be in a fast-growing industry. They may be a part of a slow-growing industry. For example, beer is a slow-growing industry, but Heineken has been fast grower by taking over market share. Same way, the bira in India. There is plenty of risk in the fast-growing companies, especially the younger ones. And also, when these fast-growing companies run out of stamina and become slow growers, markets punish them badly. For example, in USA, plastics were a revolution in 1960s, much like internet has been since 2000s. All the plastic making companies were fast growing companies, as there was a shift from steel utensils to plastic kitchenware, from wooden to plastic furnitures. Some of the biggest companies were growing more than 30% a year. However, due to high competition, the young and weak fast growers extincted and the mature ones slowed down, and then market punished them with negative returns. But for as long as they can keep it up, these are the big winners. The trick is to figure out and have an insight about how much of growth is possible and is it near to becoming a slow grower soon. Category 4, the cyclicals. Cyclical is a company whose sales and profits rise and fall in a regular fashion, if not completely predictable fashion. These include steel companies, paper companies, auto companies, real estate companies, oil companies, tire companies. Charts of these cyclicals look like polygraphs of liars. Coming out of a recession and into vigorous economy, the cyclicals flourish and the stock prices zoom up very quickly. This is understandable because people build homes, buy cars, more in flourishing economy, and there is greater demand for steel, chemicals, etc. and all these commodities. But going the other direction, they suffer badly. You can lose more than 50% of your investment very quickly if you buy them in the wrong part of cycle. It takes years for economies to go under the process of booms and busts, and these generally dance with the economy. Timing is everything in them. You have to detect early signs that business is falling apart and leave. You would be a fool to not exit from them in time. If you work in some profession that is connected to steel, paper, automobiles, etc., then you have got your edge, and nowhere is it more important than in these kind of investments. For example, this is the chart of a mining company. When economy is doing good, its profit booms and so the price, and then it falls back to same place when the economy busts. Category 5, the turnarounds. These candidates are battered, depressed, and often can barely drag themselves. These are not slow growers, these are no growers and potential fatalities. If you get them right, you can make really big money depending on the time these take to turn from loss into profit. The best thing about investing in successful turnarounds is that of all categories of stocks, their ups and downs are least related to general markets. To pull out an interesting example, Apple was running under huge losses and was on the verge of bankruptcy in 1995. Had it not been their new reappointed CEO Steve Jobs and Microsoft's $150 million investment back then in 1997 to make Apple's Mac installed with Microsoft Office, there have been no Apple today. The stock price of Apple was 14 cents in 1997 adjusted to present value. In 1998, Steve Jobs came out with Mac PC with Microsoft Office installed, what Bill Gates had asked for. That product made all the difference. It helped Apple to consistently increase the revenues and turn around deep losses of the company into profits. Steve Jobs literally changed everything about Apple thereafter, coming up with innovative products like iPod and iPhone. 22 years later today, the stock price of Apple is $125, an enormous return of 890 times of your investment that you had made in 1997. These are the reward you can expect if you get them right, but feel lucky if you can exit without a loss from an unsuccessful turnaround. Category 6. The asset plays. These are the companies that are sitting on something valuable that you know about, but that the crowd has overlooked. The assets may be a simple pile of cash, sometimes it's real estate, or it may be anything else. For example, you go to buy a house which is selling at $1 million. And you notice that there is an ancient furniture which you saw was selling on eBay for $1 million too. After buying the house, you can sell the furniture on eBay for $1 million and keep the house for which you haven't technically paid anything. You can sell this house too if you want for whatever money you want, racking in profits. These companies may have huge cash on balance sheet. Sometimes due to being in a looked after industry, these also get overlooked. The trick is to buy them when no one has noticed the asset and wait for the crowd to notice the asset and sell when the stock is fully priced. Lesson number 5. Stocks to avoid. The first category of stocks. Peter says if he has to avoid one single stock, then he would avoid the hottest stock in the hottest industry, the one that gets most favorable publicity, the one that every investor hears about in the carpool and office. Hot stocks can go up pretty quickly, but since they have nothing to support them but hopes of everyone, they fall just as quickly. Peter says that when he was growing up, the hottest industry of the country was carpets. Every housewife in America wanted wall-to-wall carpet. The carpets were even expensive than the wood flooring. Everyone talked about them on news channel, that it is ever-growing industry, and within no time, 3 to 4 carpet companies were joined by 200 and more companies within a span of 2 years. High growth and hot industries attract a very smart crowd. Young entrepreneurs and venture capitalists stay awake all night trying to figure out how to get into act as quickly as possible. These include CD-ROM companies, floppy disk companies, pen drive companies, just to pull out other few examples. Second category. Another stock to avoid is the stock that is expected to be next something. The next Amazon, the next Uber, the next McDonald's. Peter says that with his experience, most of the time, it never is that next thing. Third category. Company making foolish acquisition. If a car battery company acquires a life insurance company with its cash in bank, then you have to start looking at the door. Yes, there are few of the likes of Berkshire Hathaway run by Warren Buffett who acquire everything from candy store to furniture store to newspaper and are successful at it. But if a company acquires something, it must be related to its own industry, and then they must also not overpay for it. The fourth category, IPOs of new enterprises. IPOs of brand new enterprises are very risky because they are completely overpriced, and also because of large advertisement, the crowd that comes along with their mouth open to make quick money. Only 1 out of 5 IPOs would turn out to be a good investment. Category 5. Beware of middlemen. Beware of the company that sells 80% of its product to a big corporation. Who knows, tomorrow the big corporation decides to take that same product from other company that sells it at less cost. You would have to take part-time job to offset your losses then. Okay, let's have a quick recap. Be attentive to your surroundings. Some of the future big names are beginning their journey by some product around you. If you can identify them early on, you are sitting on a big pile of cash. All of us are competent in few fields, and it is about these which we have superior insights about. Instead of looking for a potential treasure in industry you know nothing about, firstly look inside the industry that you are most knowledgeable about. As a retail and small investor, you must not think that stocks in which mutual funds have not invested is a bad stock. Most of the mutual funds underperform the market, and the reason the big institutions are not invested in any company does not make it bad, but rather make it attractive, because when they find about it, their buying would help you rack outsized returns. The 6 categories of stocks are as following: the slow growers, which grow slightly higher than the national GDP and give regular dividends. The stalwarts. These grow faster than slow growers, if invested at right price, can give you 30 to 50% return within a couple of years. These act as defensive during recession and crash. The fast growers. These grow their profits at a rate of more than 20%. This is the land of 10 baggers. But you can also run the risk of extinction or declining profit due to high competition. The cyclicals. These dance with the economy of the country and can go up many-fold pretty quickly. The art here is to enter before the cycle turns upwards and exit in time. Sitting in them for long term is a very big mistake. The turnarounds. These are companies who were under losses but turned it into profits due to change in management or launch of innovative product. The asset plays. These are where value of all assets of the business is more than the value of business itself. You must invest before the crowd knows about the assets and exit when crowd knows about it. Avoid hot stocks in hot industry. The stock that is expected to be next Amazon or Walmart, the company making acquisition outside of its core business interest, IPOs of new enterprises being listed on stock exchange, and last but not the least, from a company that manufactures very large part of its product for a single big corporation. Because if big corporation changes its mind and starts buying product from other company, within no time the profits will turn to losses and stock price will subsequently take a hit. That's it guys. If you liked the video, don't forget to like and subscribe. I will come again with lessons of another book related to stock market investing or finance soon. Until then, cheers guys.